Hello everyone and welcome back. In this video, I want to mention 4 red flags from the management teams that you should avoid if you want to invest in stocks. Because if you fall into these traps and if you don't monitor these red flags, you will have a bad performance. It will end badly and it will destroy your performance and your portfolio. So yeah, just a quick chat between you and I about 4 red flags from the management team. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now and I have achieved a performance of 25% per year. And the majority of my time is not spent looking at the numbers, but it is spent looking at the quality of the business, the qualitative analysis of what makes a business great. And because I love the qualitative aspect of investing, I look at what is good, but I also look at what is bad. And you want to avoid what is bad. So I have 4 elements for you. First red flag, that's the creativity that some management teams have when it comes to adjusted metrics. Maybe it will make you think of specific stocks out there. You have some businesses that are not profitable. So the way they seduce investor and the way they present the business, when you look at an investor presentation, some slides, they will adjust some metrics. So they will not present the net income, but they will talk about the adjusted net income. They will not talk about the free cash flow, that is negative. They will talk about the adjusted free cash flow. They will not talk about margins. They will talk about adjusted margins. And they will talk a lot about EBITDA, adjusted EBITDA. So you know what super investors think of EBITDA? They think it's the equivalent of the EBE, earnings before everything. You just remove all the costs and magically you have a very good number. Well, it's very easy to adjust your numbers. It's very easy to fake numbers and seduce illiterate investors. What is hard is to make a lot of profits. What is hard is to generate a lot of free cash flow. What is hard is to compound free cash flow at double digits for 20 years in a row. Very hard to do. Very few companies to do. That's great. We don't want to invest in all the companies in the world. The key to outperforming the market is to only focus on the top 1% of stocks. And you have only a handful of companies that are not adjusted their numbers because their numbers are already too good. Okay, so yeah, the first red flag is if you look at an investor presentation and everything is adjusted, huge red flag. Second red flag that I can also include in the first category of creativity is the mention of EBITDA. You can open an annual report of a company, any company, and you do a Control F and you check the word EBITDA. The word EBITDA. Is it often mentioned? The more often it is mentioned, the worse it is. If you look at maybe Apple should be a good example. You open an annual report of Apple, you will not find one mention of EBITDA. If you open the annual report of Berkshire Hathaway, you will not find one mention on EBITDA, or very few, like less than 5 times. And then you can open the annual report of IPOs, young companies. You will see EBITDA and you will see adjusted EBITDA. This is a huge red flag to invest in companies like this because it shows that the management is not strong enough to have real numbers, GAAP numbers. Actually, you can reverse this red flag and have a green flag. I have some examples in mind. You can spot some companies. Their adjusted metrics is not a better metric. It's actually a worse metric. Because most of the time, this is what happens for stocks. You have a bad business model, so they adjust some things. They add the depreciation amortization, they add the SBC, they add the one-off expenses, they add the impairments. So suddenly the adjusted numbers is huge and wonderful. You have some companies that are doing the reverse. They say our official numbers are too big, because we made a divestiture, for example. So you have to make a small adjustment as if we didn't make the sale of our segment, for some example, etc. We generated too much cash. You have to adjust it to really account for the performance of the business. I have one good example to show you. I can mention some companies. You have a Fair Isaac, FICO, that has done this in 2021 because they did a divestiture and they generated too much cash. So actually you have an adjusted metric that is lower than the official metric. This is great. It shows some integrity. Now you know what to look, you know what to avoid, you know the kind of companies you want to invest in. You want companies that are honest with you, the shareholder. You want companies that are not faking their numbers. If a company is always adjusted every number, I mean, come on. You are literally lying to your shareholders every day. Not good. Not good. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Second point, second red flag, you have diversification of the business model. I see this a lot with bad acquisitions, which means, imagine you have a good company and they have good margins. I can say some names maybe for this one. You have S&P Global, you have Moody's, they're in the ratings industry, right? So very profitable, duopoly in the entire US system. And also you have an index segment for S&P Global that is very, very profitable, high margins and oligopoly. Over the past few years, Moody's and S&P Global moved away from their crown jewel. They moved away from their core operations to have acquisitions to a new segments, market intelligence, so analytics segment. This analytics segment has lower margin than the ratings segment. This analytics segment is of lower quality than your original business. Why is a wonderful company in a duopoly diversifying into other segments that are bad? I'm saying bad, relatively speaking, right? Okay, you have good margins, it's software. You have a great investor called Dev Contessaria that has a fund, publicly listed, you can check it out online, called Valley Forge Capital Management. He's an investor in Moody's, he's an investor in MasterCard, he's an investor in FICO, S&P Global. He bought S&P Global in 2009, before they made all their stupid acquisitions of diversification. And then over the past couple of years, including COVID, S&P Global made some acquisitions. Even recently, they made some acquisitions. Then these acquisitions are lowering the return on invested capital, lowering the margins. And in a public interview in late 2024, if my memory is correct, he said that he was very unhappy with this diversification because you want these golden businesses to keep investing in their crown jewel and keep their high margins and do not change anything just for the sake of growth. It's okay, you will not grow as fast, but you are squeezing the juice, being profitable, and you do buybacks. S&P Global is not doing this. Moody's is not doing this. But Fair Isaac, FICO is doing this. So yeah, this is another reason why FICO is his biggest position in his portfolio for Mr. Dev Contessaria. His biggest position in his portfolio. The stock has gone up immensely, the business model is excellent, and they just stay in their lane. You just enjoy your monopolistic position, you increase your margins, you do buybacks. Don't diversify. Because now I'm talking about good businesses, great businesses. Moody's, S&P Global, they can make acquisitions that are diversifying their business model and still be excellent business models. But not all businesses are like Moody's and S&P Global. You have mediocre businesses, average, good, medium, good businesses. If Moody's and S&P Global are making mistakes because of diversification, can you imagine what a mediocre business would have as a result? You will have a lack of synergies, a lack of growth, a lack of margins, no buybacks whatsoever, just decreasing your competitive position, diminishing your moat, shrinking your moat. Very bad, because the incentives are not aligned, because diversifying your business model is bad. So yeah, that was a second red flag, things that you want to avoid. Companies that purposely diversify their business model. It's much better to invest in stocks, in companies where they just stay on their lane, invest and focus on what they are good at. Like for anything in life. You pay for a stock, you invest in a stock, you know what you're getting. You don't want this additional risk of execution. What if they make an acquisition and the acquisition turns out bad? What if you don't have the synergies that are expected? What if the margins are decreasing in the future? You don't want this kind of uncertainty in the future. So I see diversification through M&As as a red flag that I want to avoid for my portfolio. Okay? This is also another reason why in my portfolio I am invested in MSCI and not S&P Global, because of these distinct capital allocation decisions. Third red flag here, externalization of problems. Never their fault. You have some management teams that are blaming the world and never having any accountability whatsoever for their mistakes. So imagine you have a guidance for a company and then the company misses the guidance for revenue, for margins, for earnings, and then they will blame the macro. Yeah, it's because of the seasonality, macro interest rates. Okay, fair enough. You can make 1 year like this. The year after this, they also miss. They will say, oh, it's because of competitive pressures from China. It's okay now. Next year, they will blame something else. And again, and again, and again. And I've seen this too many times. People, companies, adults that just never take accountability. But guess what? They have a nice bonus at the end of the year, so it's fine. It's perfect. They just enjoy the flow and take their massive salaries and then do nothing. You have to ask the question, who is winning? Is the management team winning because they can buy a new boat? Or are the shareholders winning because the company is increasing its per share value, per share metrics, free cash flow per share, earnings per share, revenue per share, anything? You want to check this. You want management team to be honest, have a lot of integrity, and do what is best for its shareholders. This is also why it's helpful as a green flag to only invest in companies with high insider ownership. I have an example in my portfolio. You have a Fortinet, the cybersecurity company. The two founders, CEO and CTO, they both own 7 and 8% of the company. So the two founders and brothers are owners of 15% of the company. They want the stock to go up. They want to improve the per share metric, earnings per share, free cash flow per share, okay? They don't want to screw investors over. They have, their incentives are pretty much perfectly aligned, okay? So yeah, some management teams are not honest, lying and never taking any accountability whatsoever. This is a massive red flag. I mean, they are grown-ups and they don't want to make mistakes. It's okay. You can make a mistake. I've seen plenty of management teams online. They make a decision and it turns out it's a bad decision because we learn about the new world and we say, no. Some management teams are very honest and say, we screwed up. It's okay. We'll take the loss and move on. And I love this. The management team is clearly honest, blunt. He says, okay, we screwed up, but next year we'll no longer do this at 0%. So let's move on and find another challenge. You have a great company that is doing this, Technion from Sweden, okay? A serial acquirer. You can see their slides, their slide deck, investor presentation. They are maybe the most honest investor presentations I've ever seen. They are literally have emojis of blood, like we are bleeding cash. So a blood image saying we screwed up. This is terrible. The acquisition was horrible, terrible. We know it. We screwed up. We will improve on this one. Here is our action plan to maneuver the situation. Step 1, step 2, step 3. Boom. What a wonderful way to interact with your shareholders, right? It's way better to have this with a lot of accountability rather than some specific words about the weather. Oh, it's not us. Oh, it's because of the interest rates. Oh, it's because of inflation. Oh, it's because we have bought too much inventory, oversupply, over demand, supply chains too bad. It's never our fault. I'm surprised. I mean, you have so many management teams that are never taking any responsibility. This is a bad way to invest and manage a business. But anyway, fourth red flag for you, lying over guidance. a lot of management teams are over-promising and under-delivering. I've seen many companies doing this. I mean, the most common example is, of course, Elon Musk, which is quite funny. He's maybe the most successful person in the planet right now, maybe the smartest. But if you look at all the guidance, all the promises he has made in the past, very few of them actually came true. So he has, with Tesla and SpaceX, Elon Musk has a track record of over-promising and under-delivering. Like, we will visit Mars in 10 years. Well, we're still here. We will have robotaxis in 2023, 2024, 2025, again and again and again. So it's an obvious example. So I will not invest in Tesla. One of the reasons I will not invest in Tesla. But you can reverse engineer this. You want to only be invested in companies where the management teams under-promises and over-delivers. A good example, coming back to this, is FICO, Fair Isaac. Always under-promising, always over-delivering. You have another company that has been doing this for many years now, Pool Corp, swimming pool equipment company, doing this. Pretty conservative. So a good way to check this is to check the guidance. You have some websites online where you can check what the management said and check what the management did. The guidance, and if they beat the guidance, beat and raise, revenue and earnings. You can also find some companies that have what they call a 5-year plan. I can mention an example for you. SSD, Simpson Manufacturing. They sell wooden connectors for houses. Very boring, very niche. This is why I love my job. And they have 5-year plans. Okay, so every 5 years we say, okay, here are our plans for the next 5 years. We want the margin to be this. We want the revenue to be this. We want this. And after 5 years, you can check if they reach their goals. Most of the time, the majority of their goals are met. So they have a proper guidance, they execute well, and they over-deliver. This is lovely to see, and this is why SSD, Simpson Manufacturing Corp, is on my watch list, because it's a lovely business and the management team is very clear with its objectives. So what is great with these 4 red flags is you can reverse engineer to actually find 4 green flags. Okay, you want a management team that is competent, with a lot of honesty, integrity, that is here for the benefits of the shareholders, and it is thinking on a long-term basis. These are some qualitative analysis you can make to finally outperform the market. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.